So let's talk about one of the biggest challenges in trading, how to actually achieve real, lasting consistency, especially in the wild world of gold. You know the feeling, right? You have a fantastic week, you're up, you feel like a genius, and then one bad day, maybe even one bad trade, just wipes it all out. Well, we're going to unpack how to stop that from happening.
And we have to start with the big, honest question here. Why is it that so many traders, even smart ones, just can't seem to stay profitable trading gold? Here's a hint. It probably has nothing to do with predicting the market. The real reason is usually much, much simpler, and it all starts with chasing the wrong goal.
And this is the first huge mindset shift you have to make. See, the goal of a professional trader isn't to win every single time. That's a fantasy, it's impossible. Real consistency isn't about how often you win. It's about how well you protect yourself when you lose. It's a game of defense, not offense.
So, here's our game plan. We're going to start with what I call the gold trader's dilemma. Then we'll redefine what consistency actually looks like for a pro. We'll cover 3 simple rules for survival, dive deep into mastering risk, and wrap it all up with the final takeaway: discipline over excitement. Okay, first things first, we have to understand the battlefield. Gold is a different animal. It doesn't play by the same rules as other markets, and if you treat it the same, you're setting yourself up for a world of pain.
So what makes gold so tough? Well, for starters, the moves are lightning fast. Prices can just explode or collapse in a matter of seconds. That creates insane volatility, which is where the opportunity is, but it's also where the danger is. And all of that chaos creates this intense emotional pressure. Fear, greed, panic, they all take over the driver's seat. And I promise you, emotions will absolutely destroy your profitability.
All right, so we know the challenges. How in the world do we actually deal with them? It all comes back to a professional mindset shift. We have to totally redefine what we're even aiming for when we say the word consistency. And this slide, this really gets to the heart of it. The amateur is completely obsessed with winning every trade. Their ego is tied to being right. But the professional, they know they're going to have losing trades. That's just part of the business. So their entire focus shifts from trying to win to ruthlessly, obsessively controlling every single loss. That's how they survive to trade another day. Survival is the whole game. So this brings us to the core of our strategy. If the goal is survival, if it's all about managing those losses, how do we actually do it? Well, here is a super simple, actionable framework. It's just 3 rules. That's it. And the rules are incredibly straightforward. Number 1, trade at the right time. Number 2, use a simple, repeatable strategy. And number 3, the absolute most important rule of them all, protect your capital. You have to guard it like your life depends on it, because in the world of trading, it really does. Let's break them down. Okay, rule number 1 is all about timing. Look, the gold market is most active and, frankly, most predictable during the London and New York trading sessions. This is when the big banks and institutions are moving money, which creates high volume and cleaner moves. The Asian session, on the other hand, is often choppy and just weird. So the bottom line is simple. Fish when the fish are biting. Stick to the times when the odds are stacked in your favor. Rule number 2, your strategy. Seriously, forget about cluttering your charts with a dozen complex, confusing indicators. The pros keep it incredibly simple. Your entire job is to identify the main direction of the market. Is it going up or down? And then use the most powerful tools in trading: basic support and resistance levels. That is it. Don't make it more complicated. Clarity is what leads to good decisions. And that brings us to the golden rule, the one that holds everything else up. You must protect your capital at all costs. You could have the most brilliant strategy in the world, but it is completely useless if you lose all your money on a few bad trades. This isn't just a friendly tip. This is the absolute bedrock of a professional trading career. Which brings us to the most critical piece of this entire puzzle. Seriously, this is what separates the people who make it from the people who blow up their accounts. Mastering professional risk management is the non-negotiable key to long-term survival. So what does that look like? It all starts with one single number: 1%. This is the most important rule of risk you will ever learn. You should never, ever, under any circumstances, risk more than 1% of your total account on a single trade. No exceptions, ever. This mathematical rule makes it almost impossible for a string of losses to knock you out of the game. And here's exactly what that looks like in the real world. If you have a $1,000 account, your maximum loss on any one trade is $10. That's it.
Have a $10,000 account? Your max loss is $100. See, this isn't about being timid or limiting your profits. It's about ensuring that no single trade can ever deliver a knockout blow. It takes the emotion out of it and makes survival a mathematical certainty.
So how do you actually enforce that 1% rule? With this little lifesaver, the stop loss. Think of it as the emergency eject button on a fighter jet. It's a preset order that automatically gets you out of a trade if the price goes against you to a specific point. Every single trade you take must have a stop loss. It is your non-negotiable emergency exit that you decide on when you're calm and rational before you're in the heat of a losing trade.
Following these rules means you automatically avoid the classic account-killing mistakes. It stops you from using huge position sizes or overlotting, where you're risking way too much on one idea. It stops you from chasing a price that's already taken off without you. And most importantly, it stops you from making those emotional revenge trades to try and win your money back. That's not trading, that's gambling. And the house always wins. Okay, this all brings us to our final and maybe most important takeaway. This is the philosophy that ties everything we've just talked about together into one cohesive idea. If you're trading gold because you want an adrenaline rush, because you want excitement, you're treating it like a trip to the casino. And we all know how that story ends, right? The goal of a professional trader is to be boring. That's right, boring. Your goal is to flawlessly execute a disciplined, well-defined process, day after day, whether it's exciting or not. The process is what makes you money, not the thrill. And that's really what it all boils down to. Just remember this one thing. Consistency is born from discipline, not from excitement. It's about showing up, following your rules for your time, your strategy, and your risk, and just doing it over and over and over again. It's not about the sugar rush of one big win. It's about the quiet confidence that comes from a solid, repeatable process. So the question I'll leave you with is this. Are you chasing excitement or are you building discipline?